Sweet. This is fun.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Nate Tobik. He's the founder of CompleteBankData, author of the Bank Investors Handbook, and he writes about deep value stocks on Oddball Stocks and online at oddballstocks.com. I've been following Nate for a decade. He's got one of the most eclectic approaches to investing you're ever going to hear coming up right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers funds or affiliates. For more information, visit acquirersfunds.com.
So you're still doing Oddball Stocks. The bank data thing's super interesting. I want to talk to you about that because I know you've been doing that for a while now, right? Is that 5 years, more than that?
Yeah, we've changed. We were doing like stuff on the Bloomberg terminal for a while.
Is that still happening?
No, thankfully no. Those bills were killer. That was, so that
how's it work? They charge you to be on it.
Yeah, it was only I want to say $500 a month per terminal, but they had some deal where you had to buy 3 or something. So I ended up with 3 terminals. Yeah, and I guess I was paying $1,000 or something like that a month. Yeah, that hurt.
Are you supplying them with the data, or you're getting the data?
We were they had like an app store just like Apple, and we were in their app store, and then they
but you got to subscribe to get access to it.
You'd have to subscribe to ours, yeah. And then they would advertise us along, so that we had like ads on the bottom of Bloomberg all the time, and it's a funky thing. Like there's a guy, the DeMark signals.
Yeah.
He's doing, they said something like 10 million a year or 12 million on this. And they were like, yeah, we've got another couple people doing a few million, and then some people doing, hundreds of thousands. And I thought, why not? We'll give it a shot.
Roll the dice. Yeah.
Yeah. We made almost nothing on it. We lost money after you count in the subscription cost. It was a net loss. Yeah.
What a bummer. I remember you going on. I was like, that's super cool. This thing's really blown up.
It was awesome. And it gave us, I was able to get, the PR from it was good. I was actually able to get a front page story on Bloomberg.com from it. But,
nice.
It didn't pan out financially.
That's a shame. That's a bummer. So how's it going otherwise?
Good. We pivoted from selling to investors who are totally fickle to selling to banks, and selling basically like in a state, we know who owns every property, what their financial picture is, and then you could build that out and say, Citizen State Bank, here's all their borrowers, here's what their borrowers look like, here's where they're located, and here's all their real-time activity and who's borrowing. And we've even done some stuff with clients where they're supplying us deals that they missed out on. So we have like real-time rate data for specific products in the market. So that's cool. And,
yeah, that's very cool. And so you don't use it to invest. How are they using it?
They are using it to find new lending, like new borrowers, and also to stay ahead of the competition real time. That's awesome. They know more about what the competitors are doing than they probably know about themselves, and they could react to that.
And still growing?
Yeah.
What sort of growth rate are you seeing?
So we were doing really well. We were doing like 30-40% a year up until COVID, and then we had a bunch of clients back in like March and April who were like, we want to wait on this.
Yeah.
So now we're retooling, and we're trying to push out a product for. So the problem is this: like most banks are just run by idiots and people who just like to, it's like they like the status of being a banker, right? So of the like 4,500 banks in the U.S., there's probably like 200, maybe 300 that are forward-thinking, pretty aggressive. So ultimately, that was kind of our prospect base, going after those. What we found out recently from some of these bankers who are like, we don't know how to sell, we don't care about selling, was they do care about deposits. And so we've retooled, and we have an application now where a tiny bank who knows nothing about selling loans could say, here's our depositors, here's the 2,000 people that we have deposit accounts with. And then we could find everyone in the area in the same radius of their branches that have similar characteristics. And now they could market deposit products to them.
That's awesome.
We just really launched that about a week or two ago and going to start pushing on that one now.
So how did you get your start? So the first time I became aware of you was with Oddball Stocks, and I didn't know exactly when that started. I knew it was a long time ago, but
it's like 2010.
Yeah, I saw in the note that you sent me 2010. That's amazing. So Oddball Stocks, what were you doing before Oddball Stocks?
Yeah, so I worked at a tech startup, and then from there, so I had my dad's father left me some money to pay for college, and he had done phenomenally well investing in stocks, and he owned a little insurance brokerage company, and he would invest all of his extra money into like growth companies in Latin America. And it just so happened this was like in the 80s, and all this stuff was being privatized, and he just had 10 bagger after 10 bagger, right? And so then he gave money to each of his grandkids. He just gave the stock to pay for college. So I was able to go through college. I didn't have to pay for it because my grandfather had done well investing. And coming out of college, I had like 12 grand left over. And I knew nothing about stocks. I took one economics class at college. I skipped everything but the tests and slept through the rest. And it was like, so I'd get these statements and it would show the yield on my portfolio was like, I don't know, 1.5%. And I remember thinking, I was like, that's crazy that they only think I'm going to make 1.5% over the next year on these companies. Like, aren't they going to grow? And so I started to read about it to try and figure out, like, what do I own? And from there, I got into learning about value investing. And then I networked with some people locally who are in investing professionally. And I thought, well, I'll, turn this into a career, right? And they said, take your CFA. And so I took the first level, the second level, and failed the second level, which was right as my first son was born. So like I was trying to study, I had a couple-month-old boy, and
Impossible.
it just wasn't working out. And we went to the beach, and that's where we were down at the beach on vacation, and I got this email saying I failed. And I was just sitting there on the beach, and I was like, if I spent the same amount of time studying, researching stocks, I would be so much better off. And at this time, I had turned that, so I started doing like spin-offs, probably when I learned about, kind of figured out investing. That made sense. That was probably around 2004, 2005. And I turned that 12 grand into like 50 or 60,000. And then I thought, okay, now I have some money, I could do something with this. And so I just decided I'm going to just research every couple hours every night. And I started Oddball Stocks because I'm just not a structured person, right? And so it was like I needed some place to store this information so I could go back to it and get to it anytime. And so that's what it was. I started writing on there and started doing value stuff, the spinoffs eventually. There's no juice left to squeeze from those. Those became popular. You used to write about the net nets. I did a bunch of those. Also the stuff where it's like a company is doing the reverse split.
Yeah.
Those were awesome for a while. And I was scalping a couple $100 to
Yeah, that's right. The odd lot. That's where odd lots.
Odd lots.
Right.
Yes. Yeah. The odd lots. Some of those were phenomenal. You can make thousands on them. And I just kept changing it's like I always thought of it as like little pools of water. They would dry up and you just had to move on to the next thing.
Yeah.
And so I did Japanese nets, and it was actually, those were a funny investment because Manish Pabrai was talking about those, and I thought, oh, this sounds awesome. And he gave this really compelling talk. And so I started to invest in them, and I thought this is great. I'll buy a bunch of these Japanese nets. I was riding a bus to the office every day, and so I bought the Japan Company Handbook, and I actually went through that stinking book, like every page. I made a list, and I had, I don't know, 150 tickers, and then I just bought a selection of them. I did so well on those that it paid for the down payment on the house I'm in now.
Wow, congrats.
And the irony is, right around that time I was doing well, I was at a corner of Fairfax meetup in Toronto, and Manish was there talking about how terrible his Japanese net investment worked out, and it was the stupidest thing he'd ever done, and he wished no one had done this. And I was sitting right by him, and I'm thinking, it worked out well for me.
How did it not work out for him? What was the difference?
I think sometimes people overthink the deep value stuff. And, like you could have paralysis by analysis where you're trying to find the cheapest, or you want to find something with a good business. I started buying stuff that was a net that had over a 10% return on equity, or was below 50% of book value with a 10% return on equity. And I just bought them. I mean, some of the, I went from the Japan Company book, and it would have a description like, makes refrigerators, toasters, and radiators for cars. And I thought, okay, that's what they do. I mean, I knew nothing about these companies. Yeah. And it was just a statistical thing, and it worked out really well. And it worked out so well. If, I did not hedge my yen exposure. And if I would have had, so I was working against the wind, really, because
the yen was strengthening against the US dollar most of the time through that period.
Yes. Yeah. So my investments overcame the strengthening. And if I would have hedged it, I would have done even better. And so, and there's probably still an opportunity there now, but that worked out great. And it was kind of one of those, like, you don't have to be a genius to do this. You just need to be able to execute.
You just got to be able to actually go through and do what you're supposed to do, which is buy them at a big discount to their net current asset value, and then not think too much about the business, because you're only getting that opportunity because it's a terrible business.
Yes. Yeah. Well, and some of them were good. I guess they were good businesses.
Japan and maybe unusually had some good nets. Yes.
But, the thing is, like, it actually works out better not knowing those details. And yeah. I think, I always think about it in like real world terms. So like, I like to buy and sell random stuff on eBay just because you could buy it cheap, and then, you sell it for 2 or 3 times the amount. And that's the same as like the nets. It's like, you just need to find, so I need to know that the product isn't broken when I buy it. And if it's not broken, then I just need to repackage it and, put nicer print around it and a good description. And I could sell it for a multiple of what I bought it for. But you need to know the market and know that this stuff is possible. We're doing this with, I do it. I was buying like computer equipment for a while off of government liquidation sites, and then I would resell it. My youngest brother has this like Lego village, I guess you could say. And my boys like Legos. And so they were like, oh, we should buy these Legos. So we were buying those off of a different auction site. And then so you could buy like a Lego car that's like 95% complete, right? And then there was this other site that my brother told me about where you could buy like the individual little pieces. So I would go on there and make like a $3 order for like, the pieces are like 3 cents or 6 cents. So I'd buy all these little missing pieces and then put the whole thing together. And then I sell it for like 10 times what I paid. And we kept doing that. And and then I turned to a buddy of mine who lives down the street. I told him about this. I'd say he's made almost $10,000 doing this with these Lego things. He's like scavenging these pictures for like, a half broken Star Wars ship or something. And then he's like, the kids are getting all the extra parts, and then you sell it. And it's like, to me, that's the essence of like the value stuff, right? Like, yeah, you bought the car and it's missing some pieces, but at the worst, you could make more than if you just sell it and pretty it up. You could make more than what you paid. Or if things work out and they get those pieces, you could sell it for five times as much.
Yeah, I think about them the same way. But you basically buy them when they're limping a little bit, and then
Yes.
I think it's Buffett's analogy, right? And then when they start walking properly, then you sell them. But you don't get in your mind that this is Secretariat. You're just selling it when it's not limping anymore.
Yes. Yeah, that's exactly it. And I mean, like thinking in like real life, I've interacted with some of these businesses that are they'd probably be a net, and like people recognize things are wrong and they want to change it, and sometimes just through sheer force of human will, they're able to change enough, and it goes from being we're going to close every day to hey, we'll survive. And when it looks like it's going to close, if that's when you're able to buy it, then when they survive, people get optimistic, and yeah, you just want to sell it when they're walking. That's exactly it.
Well, I feel the same way. I think you even as a business, you look at these things, and if your only analysis is, I think this thing's going to survive, rather than this thing's going to be incredible, like that's a much simpler level of analysis. Yeah, they got some liquidity. They want it changed. They want to do a little bit better, given. Like even sometimes just a quarter or given a few years, this thing will be a much different beast. And then you're buying it on its sort of broken down parts and selling it as a little business. And that's a really good way. It's a really easy way to make money in small stocks, I think.
Yes, it is. I mean, the thing I learned as well with small stocks and value stocks is you really need to approach them more as like a credit analyst. And so you say like, would I give them a line of credit for a few $1,000,000 for their continuing operations? And if you kind of look at it like that and say, are they credit worthy? Are they going to figure out a way to pay the bills going forward? And would you extend them credit? So in a lot of cases, these things so I always see first time investors, their biggest mistake is they come in and they're like, hey, look at this net. And we'll just say it has like a $50 million market cap, and it has $100 million in like assets and stuff, and then it's got all this debt laying out there, and it's like, yes, it is barely worth more than its market cap, but the debt's going to sink it. And if I was lending money, I would not lend them any more money. Those creditors are trying very hard to collateralize what they have. Whereas if you have some little cash box with a kind of a, old-fashioned business or something, it's like I would lend them money. And so if you think about it as a lender, it's like, sure, I'd make a loan. They would be able to pay it back. You're basically validating their survivability. And if you're able to validate that, and then you say, how much would I lend them? Oh, that's far in excess of, you could kind of back into like, this is another way to value them, and it's a stable business that's worth investing.
Yeah, I have a similar approach. I think what would happen if I got control of this thing and just ran it, like rather than trying to extract all the value, which the current management team is doing, in the form of salaries and options and all that sort of stuff. And I saw one yesterday, just got there a little bit late. It's like a $30 million market cap, makes small engines and equipment and stuff like that. And clearly the management is just extracting as much as they possibly can. And they've given themselves all a big bonus in the event that it goes into bankruptcy. And then they've like got the pre-pack bankruptcy. So they've gone and found someone who'll bid $550 million. So it's massively undervalued, just carrying a lot of debt. I just think if you just get there in time and you realize that this thing's going to fall probably through the equity into the debt holders' hands, maybe you can pick it up in the debt, but they're just too tough. I think it's really hard to find them at this point in the cycle. Everything's just sort of so expensive at this point. What do you do in the markets like this?
Yeah, I mean, so we've seen a lot. It's two separate stories, right? So like if you're buying the tech companies, they're flying very high, which is crazy. At the same time, some of the stuff we followed is at 15 and 20-year lows. And it's just, there's no interest. And I think compounding that is there's also the potential upcoming SEC rule that you can't invest in dark companies in a mutual fund. And so there's been a lot of forced selling, and there's really no one to buy it. And I don't know. I mean, I think these things kind of work themselves out. So like my favorite dead company is Hanover Foods, which is here in Pennsylvania. No one likes them. I have yet to find it. Every value investor I've talked to on this one, they're like, I gave up years ago. I don't know who owns the shares. There's no one. And so they had this crazy fight with the family at the top, and the brothers and the sister all hated each other, and they had this crazy trust, and the one brother maintained control through it. And then a couple years ago, they cleaned all that up, and their annual reports suddenly had all the shares, and all of that structure was gone. And you say like, well, something's going on behind the scenes. What is it? We don't know. And then that founding or the controlling chairman, he passed away this spring. So it's like there was some sort of estate planning. So now you have the children running it, and it's a cleaner structure. And it's like they have their own incentive to eventually work things out. And it might be that they get squeezed in the market and they want to sell to someone, or so. Have you ever talked to Larry Goldstein from Santa Monica Partners?
No, I haven't.
Okay, he had been doing net investing and deep value stuff. He's been doing it since the early 80s, and he returned something like 22% after fees since then. And he would always tell a story about going to it was somewhere in rural Pennsylvania. I don't remember it was I used to know the company name. Anyways, he went and sat down with the directors and said, look, you're selling for less than net current assets. Here's what this means. Did you know that comparable companies are selling at this crazy amount? And he said, here's how much money you'd make from this. And then his last slide was, here's my investment banker's name and phone number, and do what you want with it. And he said about a month later, there was the press release, we're selling, because the executives just didn't even understand how cheap it was. And when they realized they could unlock all this value and walk away, it was like, we just need the number of the guy to do it. And, he provided that. And that was it.
That's so. I worked for an activist who that was basically exactly what he did. Just walked in and explained to them how undervalued they were, and often they were being run by a founder who was an engineering background, who just didn't think in terms of capital structure or didn't understand it as an investment. And he just explained to them that you can pay out some money, or you can buy back some stock, and that will radically change the way that you're viewed in the market, and then you'll have a high share price. You can go and do other things. And when he did that, like, it was amazing how often they were like, oh, I just never thought of that before.
Yes. Yeah. It is a crazy thing. Although I'll say the pool of companies that works with has shrunk. And a lot of what's left is, for lack of a better term, run by crooks, right, or people who they're trying to pull the value out themselves. Right. And, what we've found is we've done a couple lawsuits, I guess activism lawsuits, and when you start to go looking in file cabinets and opening dusty closets, there's a lot of things that these companies are doing wrong that if you hold them to the law, which is have these annual meetings, or here's one. A lot of companies will pay friends and family a similar or the same amount as a bonus. And, you could say by law, if you're paying 10 people the same $200,000 a year, that's actually a dividend that all shareholders should get. And the court sides on, that's actually what it is. And so then it's like, well, they need to pay this stuff out. And a lot of them won't do it until they have that pressure. And so we've had some success with that. We're actually in a lawsuit right now with Life Insurance Company of Alabama, and similar thing. I think they're like 30 or 40% of book value, and all sorts of crazy stuff. And the case is moving forward, and we'll see where it goes. I mean, the mistake many of these companies make is they hire the lawyer across the street. They hire somebody who has no idea what being a listed company means. And, that's great pressure, because then when they realize they have to comply with these things, the alternative is, do we pay out some crazy settlement to shareholders, or should we sell? And, what we've told Life Insurance Company of Alabama, same thing is this story about Larry, is, look, here's all these comps. You're worth so much more, just sell. And then, it works out, and this is kind of behind you. The problem with that is, for many executives, there's a status to being an executive seen at the country
salary.
club. Yeah, plus the salary versus, a private investor or independently wealthy or whatever that. So they would rather be the CEO of a tiny little machine shop that's on the rocks, versus they have all the money from that sitting in an account, and they have to explain, that they're a private investor.
It sounds pretty good to me, but I guess it's a horse for courses.
Yes, it's, and I don't know. It's just I know of a local bank here where that's the case. The CEO loves being a bank president, right? And loves walking around the country club as a bank president. And I mean, this bank is it's been undervalued forever. They were ranting about how interest rates needed to be 6% before they'd loan money, which, I mean, it'll never happen again. So it's just, they're out of touch.
Not in our lifetime.
Yeah, not in our lifetime. And, that's just, but he liked being an executive. And so he'll stick around.
What about suggesting an LBO or something like that?
Yeah, I mean, I think they need, a lot of these companies need someone sort of sophisticated to help them with those things. And, back to what I was saying earlier about being creditworthy, if a company is creditworthy and they're investable like that, then yeah, an LBO is a totally valid way to go. And there's little private equity groups that look to do this. I think as public market investors, we just see like a small sliver. I know, so one of my brothers, he's in sales at, it would be like a deep value company, right? They do vacuum systems for machine, like if you're like, so if you stamp a credit card, there's like the little rounded corners that when it goes from square to rounded, those little pieces,
that's what they do.
Yeah, they get sucked up into this vacuum system, and they do it, and it's, the whole line goes down if they can't suck these things up. But and this vacuum company, it's crazy profitable, and it was just run by a family. And there was a little local private equity group that was buying industrials, and they paid some sort of a crazy price for them. My brother's company is also, for a while, there's the fad of like the hidden champions. And this sort of company would really fit. I mean, they were doing like, probably a 15 or 20% return on equity, or maybe even more. And their only competitor is a company in the UK worldwide. So there's just two companies that do these systems in the world, but you can't really grow the market. That it's like everyone who has them, and they break down, they get replaced. And, but it's phenomenally profitable for the owner. But it's in a Rust Belt city, and it's sleepy. And he said the factory's from 1940, and it's just what it is. So that would be a deep value type thing. But yeah, the private equity company came in, and I think they loaded them up with debt. They started paying themselves dividends, and it's kind of that playbook.
Did it run into trouble, or it's working?
It's working so far, yeah. And it's actually working so well. He told me during COVID that his company is floating the rest of the companies in the portfolio.
Wow.
So it's, these companies exist. And I think there's a lot of investors who are like, oh, if I could just find the private companies, that's what I'll do. I'll buy these and roll them up and roll up the little conglomerate and stuff. I think it's easier said than done, but they do exist. They're out there. It's just hard to find. Selling that, the people who are looking to sell, that's probably not a good deal. You need to find the company like this where they're not interested in selling, and then you cold call them, get to know the owners, and it's like same as the net. Hey, you could make so much more money. They never thought about it, and it's eventually you work with them, and they realize maybe I do just want to be at the beach house and not coming to the the grimy part of town to build vacuum machines. But yeah.
So is that how Oddball Stocks has evolved? Have you gone from really off the run listed stuff to or how has it evolved?
Yeah, so we're still looking at we still look at all the off the run stuff, and that's really it to the level. So I have a partner with Oddball Stocks, Colin, and he is able to really dig into a lot of, I guess, non-primary sources. So like a perfect example is a lot of these companies all have been parties to lawsuits, and you could request the lawsuit information. And there's all sorts of information in there that you would never see in any filing that help understand what's going on in the business. And so we've done a lot of research into these companies and kind of have this database of information on all these unlisted oddball names, small cap names that, it ebbs and flows, right? Like there's stuff at 15, 20-year lows, and then there's things that were cheap a couple years ago that are a hard pass right now. And so it's all over.
And is that, so Oddball Stocks, is it a paid newsletter now? Is that what it's evolved into?
Yeah. So we write on the blog, I think once or twice a week, and then the Oddball Stocks Newsletter comes out, I think it's 5 times a year. So it's once a quarter, and then there's an extra issue around, it's in the spring when we get all the annual reports.
Right. And so what was the inspiration for the bank data?
So it was one of those, it was a problem I was looking to solve. And this was when I, coming out of the crisis, I was looking at bank stocks to buy because they were so cheap. And I couldn't believe that some of these small banks were so cheap and they were profitable. And I just wanted a screener. I wanted a screener with bank-specific stats. And I couldn't pay for S&L. And so I looked, and they had the FDIC call report data. And I thought, I had done programming. I was working in tech, had a good buddy who'd done programming. He said, look, maybe we could pull this in and write our own screener and then screen for these stocks. And that's how it started. So it was one of those, like, I thought this would be, everyone would want to do this. I don't think screeners really make any money, but that evolved into, let's build tools for investors. That evolved to, let's build in-depth market analysis for banks and lead generation for banks. And then, now with this deposit thing, it's like, now let's build deposit analytics and find similar customers. So it keeps changing. And it went from the screener that I was thinking we would sell for some, $50 or $100 a month subscription to now it's a full-fledged enterprise product. And, there's consulting hours around building this and integrating, and we integrate with their own core systems and all this stuff. So it's changed dramatically.
Do you still use it as a screener for banks to find undervalued banks?
I have poked around with that. And so like one thing I found, and this is a secret I'll just let out, but most of these small banks, the time difference between when they release their financials to the FDIC and when you receive your annual report or letter in the mail, sometimes is between like a month and 2 or 3 months. And so if you're just able to look at that information as it comes out, you have an enormous advantage on anyone else who's waiting for the report in the mail.
That's a pretty good ad for your for your service.
It is, and we don't really do much with the investing stuff now. We've looked at like risk. We had some risk characteristics. One thing that I thought was really interesting. So in terms of valuation, when we had the product inside the Bloomberg terminal, we uh, wanted to do some valuation stuff on banks. So we had, let me think what we had. We had three models. We had it was a relative model based on price to book, price to earnings. It was a dividend discount model, and then it was this takeout model that we had. And then, so we had each model on the page and the value, and then you could adjust all the inputs. And then we had an average of those three. And that was kind of like what, the average valuation, what it should be. And so the thing I found crazy, I started to kind of like run some stats on these, is of the banks we covered, and we had like 1,200 at the time that were publicly listed. The average price of the model of what its quote fair value should be was within about 10% of the stock price for 90% plus banks. So what that means is for about 90% of the market, it was right within a band of fair value. And if you adjusted these inputs just a little bit, it would be almost exactly what the price is. And so it was kind of one of those, like, the market was pretty fairly priced and it was pretty efficient. And then you could go digging in that last 10%, and usually in there it was either the assumptions were wildly incorrect or something else was happening, and that was kind of an advantage to, you could take advantage of that by finding something in there.
And have those opportunities sort of gone away, or why not continue to pursue that?
I mean, it was really the ongoing cost of being on the terminal.
Right.
But in terms of the opportunities in banks, I mean, right now they've been written off, and I mean, in some ways you could say the market's correct, right? Because with rates where they are, I just saw the headline before we started talking that mortgage rates hit 2.98%. It's going to be very hard for a bank to make money lending at 2.8, 2.9, 2.8, 2.7, because once it drops a little bit more, you're basically lending money for no return. And right. So then you have to go into commercial mortgages to make more. And I mean, what we're seeing right now is like 4.2. Interestingly, commercial rates have not really dropped. About year over year, they're about the same from what I've seen, except for some outlier banks kind of buying market share. But that's really difficult. And so I don't know if you'd ever looked at like the Australian banks. I mean, there's
only big four Australian banks. Yeah.
But it's like they make almost no money on lending money. It's like, because rates have just been so low for so long, and we might be headed towards that same thing. And then now you have to make all your money on other products.
And those other products are riskier. Is that the problem?
Well, I mean, so some of the products would be, like overdraft and credit cards. But what's crazy is, so ramping up to this year, JP Morgan kept showing all sorts of great growth. They had earnings beats. And if you dug into that, a lot of it was on consumer lending. So they were pumping up consumer lending. And then, and you make a bunch of fees.
Is that mostly unsecured? Is that
unsecured stuff? Right. Yes. Credit cards, personal loans. And then now they put out a press release, and it was, hey, we have this enormous credit loss provision on our consumer credit because it's deteriorating quickly. Well, that was the rocket fuel on the way up. And, now that's a problem because, the marginal borrower is terrible at the top of the cycle.
Right.
And there's an analogy I heard that it bears repeating for banks. They said, bank lending is like going to a bar. It's not the first drink of the night that gets you in trouble. It's the shots of tequila as you're ready to walk out the door that are the problem. And, you know, that's it's so perfect because it's like at the top of the cycle, right as you're ready to leave the bar, you say, you know, I'll take a couple shots. That's the problem. That's what messes you up versus if right before that you would have said, you know, I think I'm done. I'm just going to go home. You would have been fine. And that's the difference between banks that they lend into disaster versus ones that step away.
So let me just go back to this is a complete non sequitur, but I've got the question written down. I kind of want to talk about it. Your grandfather, who was invested in South American companies, do you have any detail on what he did?
Yeah, I mean, so it was, he made a bunch of money on Wang Computer, that was a tech company.
Did it have a South American listing?
No,
this is before that.
That was American. And then, he started buying these Mexican stocks, and Telmex, I think is the name, or Telefonos de Mexico. That was one. And then that split off into America Mobile, which is I guess that's like a cell carrier, and I owned that for a while because I had been given this, and I rode the wave on it. So they were back in the early 2000s, they started to put cell service in, Colombia and Peru and all these different companies right as it was all taking off, and their earnings were it was a rocket ship. And I want to say my cost basis on that stock was, it was like $1 or something. And then it was like at $20 or $30 for a while. I mean, it was crazy. And the cost basis on the Mexican stock was a couple cents a share. And at one point, I remember selling it for $35 a share after college because I was like, what do I know about telephones? And, I don't know anything. It's just.
What attracted your grandfather to it? Why was he interested in South American tech stocks? Growth stocks.
I don't even know. He was not tech savvy at all, which is, I just think he had a sense of like, this is the trend. And I have no idea. I've asked that same question. Did he have
like a Fisher kind of scuttlebutt growth kind of structure to what he was doing? Did he have any, was it it's reasonably entrepreneurial to be kind of hunting around for growth stocks. Even today, somebody doing that, you'd say that's pretty entrepreneurial.
Yes. Yeah. I mean, and this was, back in the 80s. And I wish I could have asked that. So he passed away when I was in high school before I got into
what a shame.
Yeah. But I've asked my dad, who he doesn't really care much about investing. And his siblings the same. They never thought to ask, why are you doing this? And it is fascinating to me though. Yeah, his portfolio. I had he did a lot of tech stocks, and I had found some statements from back in the 80s, and it was other up and coming tech names that became really popular. And I don't know how he found these, or I have no idea. No idea at all.
And he wasn't tech savvy. So this really was, he was interested in the business. He was interested in the growth of the business.
Yeah, I think that's what it was. And he knew that, he must have known that these were good companies, that there was something there, that they were going to revolutionize things. But he was not tech savvy at all. I mean, he never owned a computer. And so it was just, but he invested in computer companies.
Did he speak Spanish?
No, none. I mean, he was over. So what's interesting though was he was in World War II, and then as he started to become successful, after my dad and his siblings all moved out of the house, so he's in his late 40s or 50s. He and his wife traveled the world, and so they would go to all these different countries, and he enjoyed haggling in the markets and just checking places out. And so my thought is he kind of had one of these, like, when you're in Singapore in 1975, it's like, look, this is this is a real place. It's not a scary thing. There's companies making money here too, and I could invest in that. And
get a souvenir while you're there.
Yeah, he had more of the globalist mindset, and it worked out really well. Yeah,
he might be one of the great undiscovered investors.
That's it. He always bragged that his biggest moment in investing was when Wayne Computer had their proxy contest, and he forgot to vote. The company was calling him because he owned, some percentage of shares, and they said, Mr. Tobik, we need your vote before we could proceed. And he was like, I'm a big enough investor that they were calling me to get my vote, and so that was his claim to fame.
There are these very famous, not very famous, I shouldn't say, but there are these two, the Kiwi brothers, the Chandlers, who started out as, I think they had one of the first department stores in New Zealand, and they sold it, and they had some money to invest, and so they bought Hong Kong real estate when they were negotiating the handover. So it was not 1999, it was like 86 or 87, and they could buy them for like 1x rental yields, these high rises. Which then they made a huge amount of money out of. And then the next step, they sort of thought, well, telephones are going to the fax is going to revolutionize business. And so they thought, where are the cheapest telephone lines in the world? And they found them in South America. And so there's an article about them in like Institutional Investor or something like that. It's one of the funny.
Yeah, I need to write this down. That's really interesting.
It's a great story about these guys because they're real frontier investors, and they've gone and they've bought. It wasn't even possible to invest in some of these countries. They had to find, in order to make the investment, they had to find a UK fund that had a charter to invest into this country, and they had to basically take over that fund, recapitalize that fund, and then push all of the investment through the fund into this. I forget exactly which country, but South American. And so they bought the cheapest fax lines in the world, and they've done spectacularly. They're multi-billionaires as a result of doing all of this really frontier stuff. It's
That's
kind of
crazy. It is, and I became really interested in the frontier stuff in 2012 when my second son was born, and I bought this book. I think I threw it away. It was like investing in Africa or something. And the book was all about how Africa is really developing and it's going to be great and it's the next thing. And I understood enough about Africa to kind of spend some time Googling, right? And what I found was this company, I think it was Brawlera, and I wrote about them. And what I did was, I couldn't figure out how do you invest. And so what the book was saying was, if you go to each exchange's website, they would have a list of brokers who are licensed to trade. And I want to say they're in, hold on. Let me just pull this up. I want to say they were in Congo, maybe. And here it is. I contacted all these brokers, and they were just telling me, send me a check in the mail. They'd email me from like an, hotmail.com address, and it was Rwanda. Here it is. So it was the Rwanda exchange, and what do? They were doing Coca-Cola bottling. That's what it was. And so the company, they had an 85% of earnings were paid out as a dividend. They had a 7% yield, and they were growing like crazy. And so I figured out how to invest. I emailed all these people, but I never pulled the trigger on it. And I wrote about it, and I started to get emails a couple years later of people who, I want to say it tripled or quadrupled, and they said, this was awesome. They said, I just sent the check to whoever the person in Rwanda was, and they had some brokerage account, and they rode the wave, and it worked out. And so that stuff's out there. It's just have to dig a little bit. But it isn't even, I mean, if you look at the Rwanda exchange, whatever 30 companies are listed, I mean, they have them all listed with links to them. And in most cases, everything's in English, and you just have to be able to take the risk.
Yeah, it's real risk capital, right? You got to be prepared to lose the lot.
Yes. Yeah. The wire might never make it. That's the risk. Yeah. But it's fun, and people did really. I mean, here's someone's comment: Rwanda could be the next Singapore of the world. Okay, well, that investment worked out. But those aren't things that you hold on forever. You try it out, and if it works, just be happy that you made a nice return.
There's a reasonable argument that Africa might be one of the great undiscovered growth stories of the world. And that, just to go back to the thing you're saying about Mexico. I mean, a lot of countries in the world don't have the legacy telephone networks built out, but because mobile cell towers don't require the legacy, they require a little bit of backhaul. But all telephones require backhaul, but they don't need to wire it, so they don't have that.
Yes.
Competing.
Yes.
So it's much easier to roll out cell phones, and then once you've got cell phones, you've got smartphones, you've got that they can make that great leap without having to build all of the infrastructure that a lot of the other developed nations have had to do. So I think there's some potential. I don't know much. I'm making it up as I'm talking about it.
You just said the thesis of this book, which was places develop at the baseline of modern technology. So when, say, Central or Southern America developed, it was at a much higher level, and they could get up to speed quicker. And that's the case with Africa now. As it's developing, they have cell towers, they have smartphones. They don't need to wire the entire country. It's ready to go. And so, like, the big thing there is you could pay for anything on your phone, just like a Venmo. And they escaped all of the crazy payment stuff that we're stuck in because it's from 50 or 100 years ago, and they started at a much higher level. So that's the argument, is if you fast forward 25 years, they're going to be so far ahead of us because their legacy infrastructure is modern infrastructure,
right?
And they have a better jumping off point.
So how are you, for Oddball Stocks, how are you filtering, sourcing, validating ideas?
That's a good question. So we've essentially just built up this database of names. The biggest thing is, so we've had this database of names of kind of unlisted OTC names. But if you start looking at OTC names, what we do is we look at the highest share prices first down to the lowest. So you're going to waste so much time looking at things that are trading for 30 cents that are just junk. Don't waste your time. But oftentimes a company with an $850 share price or a $3,000 share price is worth looking at. So like a good example is
Boswell or something like that.
Boswell, or right in your neck of the woods, Farmers and Merchants Bank is, I want to say they trade at like 5,600 a share or 6,000 a share. I just got their annual report yesterday, and it says right on the front, California's safest or strongest bank. That's their tagline. And
that's interesting. There's a few big banks here.
Yes. Yeah. And so, but it's this high share price, and you look into these, those are the ones that are interesting, and then work your way down. And, amongst the cheap stuff, like cheap in terms of nominal price, there's some interesting things, but usually by the time you get down to those prices, you've already filled up your watch list.
So are there any, what are the special risks to trading this sort of stuff? Because these are not listed. The pink sheets?
Yeah, pink sheets sometimes. Yeah, some of them are listed, and some of these are just kind of off the beaten path names. But the risk is really that they stop treating you as a shareholder and kind of pretend you don't exist. That's true. That's the risk is, if you aren't willing to do some work to potentially unlock value, you could just be stuck in it until, someone like us comes along and tries to unlock the value. And And then now the risk is that a lot of brokerages are cutting off some of these companies,
Right.
and they say you're not able to invest in them. Brokerages cutting off access is kind of interesting in the sense of it's a negative and it's an opportunity, right? So the pool of investors who are going to be investing is significantly smaller. In some ways, it's actually a better investor pool because most of them are very well educated as to what's going on. And, so one thing we found with the Life Insurance Company of Alabama is that there's the family, there's a bunch of shareholders who maybe they own 100 shares from 1970 and they just had forgotten about it. And then there's this pool of sophisticated value investors who know the name. And then we got in touch with a lot of them and they said, yes, we absolutely want to be a part of this lawsuit because, we're all going in the same direction, right? And so I think in some ways it distills the quality of who the shareholders are. And the opportunity is if you are still able to buy them or you have a prime broker that could buy them, you could now get stuff a lot cheaper because people are being forced out because Fidelity won't let you buy it, or TD Ameritrade will let you buy almost everything. So if there's still a broker, that's okay.
And how do you work with these campaigns? Do people invest behind you and you're managing a pool of capital, or do you split expenses with them? How does that work?
Right. So right now we just split expenses, just as a bunch of different entities. We've tossed around the idea of building out an activist fund that actually does this, that takes a pool of capital, invests, and as a fund works to unlock the value of these different names. We're kind of testing the waters on that, but I think that would be the next evolution of some of these. Yeah.
You could even do them on a case-by-case basis, just raise a special purpose vehicle for a single single name.
And that's kind of the idea is, if you look at the universe of what's out there, right, and you say, I'm just making numbers up. Let's just say that there's 10 companies that are perfect for this. You start to build your position in the things that you're going to, do a campaign against last, and sort of slowly build your position, and then come in with an entry position on a couple of the ones you're going to do right away. In theory, this stuff, over a lifetime of say 5 years, you're hoping to realize value on most of those names, and then it's like, we did the 10 campaigns, we're done, we'll spin that down, here's another 5 or 10, and you kind of what you're investing into. It's like, here's the companies, here's what our mandate is, this is what we're going after. And
that's interesting. It's almost like a private equity venture capital approach to activism.
It kind of is, yes. Yeah. And we don't want to own the companies. That's the other thing is, we don't want to be empire builders and own a bunch of things and roll them up. It's really, look, this, so a friend of mine always had this analogy. He said a lot of these names to him is like a vault in North Korea full of gold. And he was like, he goes, to me, the vault is there and the gold is there, but you're never going to get the money out. And what we're saying is, in essence, we're going to kind of create a specialized SEAL team to go and get the money out of each of these vaults. And that's it. Once it's out, the mission's accomplished.
I like that. I like that analogy. I saw yesterday someone has a silver deposit, and rather than mining the silver and storing the silver, what they've done is they've turned it into coins. So that you just store the silver in the ground and you trade the coins based on what you think is there.
That's interesting. Yes, it's the metals. I've been fascinated by the metals. We talking about like collecting and stupid value stuff. Like, I'll give this away too. I was buying there's silver coins of Nui, I think is the name of the island. It's somewhere in the Pacific. I want to say it's part of New Zealand. And so they put Star Wars people on the coins, and each year they have a release. So if you So when they come out, they're sold at the silver spot price. So like earlier this year, you could buy a coin and it would be, $17, and it had I bought a bunch of them with Darth Vader, and then the other guy. I'm not a Star Wars person. My kids are. The same kind of guy as the Mandalorian. He has that like helmet with the line in it. Anyways, I bought a bunch of these, and they roll off each year. So like I bought the Darth Vader ones right before they were done selling them, right? And then suddenly there's no more supply, and prices on eBay, now the sale prices are like $35 a piece. So
Wow.
like I basically doubled my money on Darth Vader. I need to wait until this year ends for this other Mandalorian kind of guy. And but if you look back like 2, 3, 4 years, the prices they're like $60, $100 a coin or more.
Wow.
And it's like it's just incidental that they're silver, right? It's like, but I was explaining to my kids, I said, look, this is a perfect investment because we're paying the silver value, and at worst we sell it back for spot and we lose the spread. And I said, but at best, some Star Wars collector wants to buy these things and we make some multiple of our money. And so they love that. They think it's great. And that's like a learning lesson for them, right? But yeah.
Absolutely fascinating, Nate. One of the most eclectic discussions I've ever had. If folks want to follow along with what you're doing or get in contact, how do they go about doing that?
Yeah, so you could shoot me an email directly. That's ntobik at completebankdata.com, or check us out at oddballstocks.com, or the newsletter's oddballstocksnewsletter.com.
And bank data, bankdata.com.
CompleteBankData.com. Yep, and you can follow me on. I post a lot on Twitter now, and my handle is just Oddball Stocks.
And you wrote a book on banking. Don't forget to mention that.
That's true. Yeah. So I wrote a book, the Bank Investors Handbook, and basically I did that because when I was getting into investing in banks, this is the story of my life. I can't ever find the things I need myself, so I create it. I wanted a simple book that told me, how do I understand banks? How do I look at them as an investment? There was nothing out there except some old PDF someone wrote in 2002, and I wrote the book. And so if you're interested in learning about banks or just understanding banking and bank investing, that's a way to go as well.
That's fantastic. Nate Tobik, Oddball Stocks, thank you very much.
Thank you for having me.